Well, financials have been in focus since the collapse of Silicon Valley Bank in mid-March, but even strong bank earnings and confidence in the sector, echoed from JP Morgan CEO Jamie Dimon earlier today, haven't pushed markets. Instead, investors digesting the latest batch of economic data, including declining consumer spending. Joining us now to discuss where investors should be focused as the mixed signals continue to come in is Lisa Erickson, US Bank Senior Vice President, Public Markets Group Head. Thank you for joining us, Lisa. So, as we try and we've got this first snapshot from the banks, but what is that actually telling us about the health of the economy?
Well, overall, what we've seen in the earnings that have come out so far for the first quarter is we've actually had some nice beats on expectations. But we are really geared up for the remainder of the season, particularly a couple of weeks out when we get really the bulk of the reporting. And the simple reason why is that companies really have a number of headwinds that they're facing, whether it's elevated interest rates, whether it's potential slowing of credit conditions with potentially more cautiousness in how much credit is extended, and of course, slowing activity in general, including the consumer. And so because of that, we are actually more cautious overall in the U.S. equity market. Those headwinds that are ultimately facing companies, as well as, and we haven't mentioned Fed policy, really, again, could lead to some continued volatile behavior for the U.S. stock market.
All right, well, then let's mention Fed policy. What is your expectation for the next meeting?
Well, certainly, I think all eyes are on whether we get some sort of pause and even potential pivot later in the year. But again, we're relatively more cautious on whether those events may take place. We have had an environment where we've seen some levels of inflation come down, but they're still at higher levels than the Fed really wants to target. And in addition to that, Fed officials, even some of the speeches today, really continue to indicate a focus on dampening those price pressures. So there certainly is momentum on their part to continue to try to keep that policy on the tighter side.
Now, we mentioned some of the Fed voices here. I want to turn your attention, though, to Atlanta Fed President Raphael Bostic. He said that the Fed could hit the mark with one more rate hike and then they hold. What's your take on that? And what message do you think that might send to markets?
Well, certainly we're near the end of the Fed tightening cycle than at the beginning, with the dramatic increases that have happened over the course of 2022. What we see, though, however, is, again, the Fed is still under pressure really to make sure they're combating those inflation measures. And what we have, therefore, is somewhat of a disconnect between what the Fed says they're going to do in terms of the public comments they've made, as well as the projections they've put out in their minutes and meetings and so on, with the market expectations. So again, we still see some risk of potential correction given the gap that the market is actually thinking that, again, the Fed can slow down more than the Fed is saying it may do.
So given that environment you just laid out and the headwinds you laid out prior to that, you prefer what types of companies moving forward?
So we're generally cautious again on the U.S. equity market. And so for those clients with really more of a shorter term time horizon, that within a year or so, we really are emphasizing more defensive types of sectors such as utilities or consumer staples or healthcare. And what's really nice about these kinds of sectors is the fact that they often have nice dividend yields, which again brings that return in up front and can buffer some of those price volatility moves. And in addition, these are companies that tend to have more steady eddy earnings over a cycle. And so that, again, can be attractive in a higher economic uncertain environment. And so really looking at some of those defensive names we think is a place to emphasize.
And Lisa, for people who have a longer timeline, perhaps looking at some of these growth stocks, what are you looking at in that space?
Absolutely. For clients that really are further out than a year in terms of their objectives and the horizon they can take, we do see some growth stocks such as technology, consumer discretionary, and communications is quite interesting. And really the reason why is if you think to some of the secular tailwinds that are going on, whether it's machine learning, continued use of big data sets, access to anytime, anywhere connectivity, these are the kinds of companies that will both be able to propel as well as take advantage of those trends. And so that really leads to some very nice revenue and earnings profile longer term.
Certainly be keeping an eye on that. We'll be sure to have you back to get updates on that. Lisa Erickson, thank you as always for joining us.